The complicated mergers and acquisitions industry is perfectly characterized by Charter Communications' unsolicited bid for 100% of Time Warner Cable. Charter's first offers to Time Warner took place in June of last year and again in October. Management of the two companies negotiated privately but were unable to come to an accord. On January 13th, Charter took a different approach by bypassing Time Warner's board of directors and appealing to shareholders directly for a share price of $132.50 for a total deal size of $61 billion. This bid was also rejected outright by Time Warner management as a lowball offer, but the Time Warner board and key shareholders of the company still appeared to be willing to make a deal at a price closer to $160 per share. Another issue to contend with is a stock cash mix of proceeds used to fund this purchase. Currently, Charter is offering $83 per share in cash and $49 per share in Charter stock, an arrangement that would grant Time Warner shareholders approximately 45% ownership of the newly formed company. Time Warner management and shareholders would like to see at least $100 per share in cash. A successful merger would create the third largest pay TV provider behind Comcast and DirecTV, and is unlikely to face much opposition from the Department of Justice, as the two companies do not compete directly in the same markets. A compelling development in the stalled deal are the upcoming elections for the Time Warner Board of Directors. As opposed to staggered elections, in which only a certain number of board seats are up for bid at once, all 13 seats are available for takeover with the upcoming election. Charter is planning on nominating candidates for all 13 seats in the coming weeks, and a victory in a substantial number of them could significantly improve Charter's chances of closing a deal at their desired price. In recent equity market news, action camera company GoPro announced plans for an IPO on February 7th. The company filed its paperwork confidentially with the SEC as a means of protecting the valuable information that must be exposed when going public. This does give some insight into the company performance though, as the company must have less than $1 billion in revenues in order to register privately as GoPro has. The decision to file confidentially highlights some of analysts' primary concerns with the company's future profitability prospects. While GoPro's known profits and growth have been impressive, the lack of a real competitor in the durable, go-anywhere camera industry worries investors about the effect that an inevitable entrant to the market would have on GoPro's sales. Another concern is the dependence of the company's success on a single product. Skeptics doubt CEO Nick Woodman's ability to continuously deliver sufficient improvements to the line of hero cameras to entice customers to continue purchasing. A past financing deal with a subsidiary of Foxconn Technology Group valued the company at $2.25 billion, with a $200 million investment acquiring just under 11% of the company. If a public offering is approved by the SEC, more details will come to light about the company and its financials in the coming months.
The SEC released a draft of its strategic plan for the next 5 years earlier in the month. The report raises concerns as to whether IFRS will ever be adopted in the United States. Text in the report indicates that the SEC is shying away from the possibility that U.S. companies will ever be able to file under IFRS. The SEC proposed a roadmap for adopting IFRS in the U.S. back in August of 2008. These efforts were thwarted by the financial crisis when the SEC began to focus on other matters. And with this new commentary from the SEC, there are now serious questions as to whether this will ever happen. Moving on to the global markets, certain products have begun to experience abnormal volatility. Global equity markets have rebounded so far in February after a rough January. Many analysts are predicting positive stock returns for the year, so gains are expected to continue. Along with earnings announcements, significant events for the equity markets in the U.S. are likely to be the ongoing debt ceiling debate and actions by the new chairwoman of the Federal Reserve, Janet Yellen. Emerging market currencies have been under pressure as the Federal Reserve winds down its quantitative easing operations. When QE began, money flowed out of the United States and into emerging market economies where it could earn a higher rate of return. Now that QE is ending, the money is being pulled out of emerging markets and repatriated back into domestic economies. This has caused emerging market currencies to essentially crash as money is exchanged from these foreign currencies back into domestic. The volatility can be seen in the Argentine peso, which was recently devalued from 6 pesos per US dollar to 8 pesos per dollar. Argentinians with their life savings in pesos lost a significant amount of their purchasing power as a result of this. The Turkish lira has also experienced abnormal moves. Turkey's central bank raised the overnight lending rate from 7.5% to 12%. In an attempt to stem the flows out of their currency. For the time being, this appears to have stabilized the lira. On the commodity front, volatility can be found in the natural gas and coffee markets. Record cold temperatures have given natural gas a range of almost $1.50 per thousand cubic feet over the past couple of weeks, a move of almost 30%. Many are speculating that a number of institutional funds who are involved in the energy markets have been hurt by this volatility. Swings like this are why natural gas is nicknamed the Widowmaker. Coffee has also risen nearly 30% as concerns over supply plague the market due to drought and extreme weather. Analysts estimate the market could rise another 30 to 40% from current prices if Brazil does not get enough rain by the end of February.
Hedge funds and private equity are in decline since 2008 financial crisis. However, since January, they did better than stock market, declining in less percentage. Hedge funds' average fall was 0.1%. Global stocks declined 4%, including reinvested dividends. On the other hand, biggest hedge funds continued their gains, such as Citadel and Berkshire Hathaway. Beginning in the 1950s, hedge funds and private equity managers' fees were 20% of profits, in addition to 2% annual charge. The 2 and 20 became standard until recently. Investors having power and getting bad performance in recent years led them to fighting back those rates. By 2013, some of those fees were down to 1.4 and 17%. Management fees are down by 30%. Performance fees were down by 15%. This shows that investors are still somewhat willing to pay for good performance. Another reason is that hurdle rates are set around 8%. Below that, hedge funds and private equities get nothing. Major hedge fund firms are now positioning to provide loans in commercial real estate such as hotels and malls. Especially after the shrinks of returns on other credit markets, the returns that are expected for mortgage-backed securities are as high as 15%. Examples of investment firms preparing for real estate: Axonic, preparing for $1 trillion with 10-year fixed-rate loans; Libor Max, investing in hotel debt; and Winston Saba, which moved to real estate in 2013.
As of the first quarter of 2014, the U.S. economy is showing promising signs of growth. The Fed's December announcement regarding the tapering of its quantitative easing program came as no huge surprise to investors, and it left the markets relatively unharmed. As of January 29th, the Fed has reduced its bond buybacks by $20 billion to a monthly total of $65 billion. After reaching record-breaking highs in 2013, equity markets in the United States have continued their ascent in 2014, despite some minor volatility in the past months, spurred by problems in developing markets. These problems are due in part to the aforementioned tapering, since, under the quantitative easing program, huge sums of money were leaving the U.S. for investment in emerging economies. This reduction in easy capital, combined with an overall slowdown in emerging market economies, dealt damage in the developing world that has rippled back to the U.S. Corporate profits are also at record-breaking levels, 40% above the pre-recession peak, due to the combined effects of a real GDP higher than pre-recession levels and lower employment rates. This means that corporations are making more money despite employing less people. While this is promising news, labor markets aren't necessarily rejoicing. Though the unemployment rate of 6.6% is at its lowest level since October 2008, only 74,000 jobs were added in December, and only 113,000 were added in January. These figures were far below analyst expectations, and they contributed to the puzzling situation in labor markets. The investment banking environment in the United States is in a state of change, thanks in part to the Volcker Rule. Part of the Dodd-Frank Act, the Volcker Rule bans banks from engaging in proprietary trading, which has traditionally been one of the major revenue generators of investment banks. This change will force investment banks to make up for these lost profits by bolstering their sources of core funding and also by creating new ones, as seen by pure-play firms such as Goldman Sachs, adapting to a more universal role by expanding on the depositing and lending functions. Thankfully for investment banks, opportunities abound outside of proprietary trading. Riding the surge in equity markets over the course of 2013, investment banks saw their highest equity underwriting revenues in over 3 years during the fourth quarter of 2014, which totaled over $264 billion. Goldman Sachs alone saw a 125% increase over the third quarter of 2013 in underwriting fees. This was due in part to healthy IPO and follow-on offering activity. The boost in equity underwriting revenues is particularly good news when viewed in context with the Volcker Rule. Strong equity underwriting revenues show promising signs of growth in the still viable product lines offered by investment banks.